You're watching the Financial Sense News Hour, financial news for high net worth investors and strategists. When it comes to the biggest investment trends and understanding the market, we've been delivering the insights you need for over 30 years.
Well, if you've been looking for gold to improve, well, that happened this week. It looks like gold is back in the saddle. Couldn't think of a better person to have on the show. Joining me is Greg Weldon. He's publisher of the Global Macro Strategy Report. And Greg, you started out with your report back in the saddle again. So let's begin with gold. I'm looking at a chart here. It broke through the 50-day moving average. Silver looks like it's ready to do the same. So let's begin with that.
Exactly that. Harkening back to the album Rocks, when there used to be just albums, and we used to create the list of what's the 10 albums we'd want to have with us. We get stranded on a deserted island, and Rocks by Aerosmith was always one of them. Great songs. And back in the saddle again. And what's funny is I started the week with back in the saddle talking about the renminbi and copper, and then that morphed into back in the saddle on gold, silver, the mining share ETFs, and even the dollar on the downside as the renminbi is rallying. And then today I did back in the saddle with uranium. So there seems to be a lot of this kind of going on. I think some of it's tied back to the dollar. And I think that when you have a situation in gold where open interest is very low, we have not seen really any, little burst in open interest, just this rally. You're coming off key long-term Fibonacci technical levels in both gold and especially in silver. Silver has a fascinating technical look to it. You could say it's a 1, 2, 3, 4, 5 decline. You could say it's an ABC decline. It matches the Fibonacci dynamics, and it fits in with the long-term moving averages. You talk the 50-day. It just took out, I used the 50, 100, 200-day exponential moving averages and the 52-week and 2-year. That's it on everything that I look at. And I'll tell you what, really phenomenal how tight these moving averages can be sometimes. And you're in a situation now where you're threatening the 50-day as the moving averages have rolled over, but the long-term moving averages still remain bullishly aligned. The long-term trend is still very much intact, and the short-term decline has been such that it's driven the momentum on the medium term to levels that in the past have marked bottoms. You throw in the fact that the dollar is now threatening the uptrend line. It goes all the way back to the 2008, 2011 low, a low which came off the bear market in the dollar that began in 1985 at the Plaza Accord. You hear talk now from officialdom about the IMF says Chinese currency is 21, 22% of our value. You're hearing talk about a new Plaza Accord that would move to strengthen the renminbi. And I think that's a key dynamic to talk about too in the background in terms of gold. But I think when you look at the big picture technical, you look at the psychological, you look at the dynamic around the Fed, and then you look at the dollar, you've kind of come this full circle through this correction to where I think gold and silver are about to climb back on the horse.
Well, it's amazing too because it seems to be
I think they're
decoupling.
there. I mean, as of this week, I actually think they're there. I really do.
Okay.
As of yesterday, as of Wednesday's rally, to me, that was what kind of sealed the deal technically for me, that they are back in the saddle.
Well, also, it seems like gold is decoupling from interest rates because on the day you and I are doing this on a Thursday, 10-year yields at 4.67 and the 30-year bond is at 5.21. So rates have been
Yeah.
rising, which many say has
Right.
hurt gold, but doesn't seem to be hurting it now.
Yeah, because I think you got to go deeper in the analysis with the interest rate dynamic, especially as it relates to the Fed. And I think that when you had a situation where Warsh comes out of the gate, invokes the ghost of Paul Volcker right off the bat in his first, press conference, then there's testimony on Capitol Hill, which followed very closely on the back of that in a kind of a June-July double whammy. He came out as he needed to, vigilant on inflation, but he came out to the point where he's saying we're going to move inflation to the left side of the decimal point, meaning 2% is not the goal. 1 point something is the goal, below 2%. He invokes Volcker, who raised rates to 20% to defeat inflation from the 70s and the Carter era inflation. So then he comes and he doesn't raise rates in the first meeting. Now, during this entire time where you say interest rates have been hurting gold, it's not so much interest rates as the fact that the yield curve had been flattening. That this was a dynamic where, long end yields were kind of coming down because the thought process was out of the gate that Warsh is going to be tough on inflation, and that's going to put short-term rates up. It's going to help squelch inflation. It's going to bring the back end of the yield curve down. And you had a flattening move, I should say, flattening in the yield curve. All right. That has now shifted because Warsh did not act. He's already lost some credibility. Look, Japan didn't act, and now they had to bail out the end using U.S. taxpayer money. I mean, this is a lot to ingest when you start talking about inflation. And then you kind of say, well, interest rates now, guess what's happened? The curve is now steepening because the long end is now rising, fearful that the Fed may already be behind the inflation curve. It's all well and good that Donald Trump's trying to tell us that, gasoline is going to be free in October, right? I mean, that's pretty much what he just said. It's going to come down so much that it'll, shake the whole economy up. The problem with that, though, Jim, is and I know, the mathematics don't play there because it dropped to $1.67 last fall. You got to get below that level to have a negative impact on the inflation data. The curve for forward inflation through the rest of the year on gasoline is 35 to 50% year over year higher. And if it goes higher, that's a big problem. So this is why, that Trump's kind of been boxed into a corner. He painted himself in a corner with his mouth, and now he can't get out without getting paint on himself. So this is a kind of a bad situation, which also turns back and hurts the dollar, but also lifts bond yields. And this whole thing around Japan, where he spent $10 billion plus of U.S. taxpayer money to bail out the yen, and that may be a little exaggeration. The MOF threw some cash in, too. Bottom line is fear of the U.S. debt black hole, almost 40 trillion to 39.8 something now in U.S. public debt. Throw in household debt, you're talking $60 trillion of debt, all right, at a time when bond yields are at an 18-year high. I mean, that's problematic. With the largest international holder of U.S. debt, Japan, the currency's collapsing. So this is kind of a mess, and I think it bodes poorly for the dollar, and that in turn bodes well for gold and silver, not so much because of the interest rate picture, but the deeper dive into the interest rate picture.
Greg, I always found when they were talking about Warsh being a hawk, I found that a little bit hard to believe, given that, as you just mentioned, we're almost at 40 trillion in debt. In the second half of the year, they're going to have to raise $1 trillion of new money just to pay the 2 trillion debt that we're going into. Interest payments on the debt are over 1 trillion, and we have 40 trillion in debt. And you're telling me you're going to raise it like Volcker? I just don't see that happening. It would collapse the market.
Yeah, and not only that, he wants to shrink the balance sheet, which is ludicrous. And they're expanding it anyway, and they're using the cover of we need to maintain enough liquid reserves and so on and so forth. And they can say whatever they want. But and I know, Jim, and I've said this before, number one, thinking you can come in here and shrink the balance sheet is pure folly. It's not happening. There is no way, okay? Not especially when you talk about the interest on the debt's $1 trillion. You got a $2 trillion in new debt. You just went from 36 and change to almost 40 like that. I mean, it was really fast, this most recent expansion in debt, the last half of last year, first 2 quarters of this year. So that's problematic. And so to me, this was a situation where you don't want any more pressure on the bond market, especially if Japan were to have to sell part of their treasury holdings. So of course we go in there and bail their currency out. But I think that this is a big deal where Warsh had to come in and talk tough because he had to kind of distance himself from Trump. He's not going to come in and be a Trump puppet, and that's great, But invoking Paul Volcker to me was a mistake. He likened himself to Volcker. He talked about the left side of the decimal point. He's going to come here and raise rates. I mean, I just don't see that. Because I think we've talked about this before. When you are staring into a debt deflation and a debt black hole, you will choose to reflate at any cost, and that usually comes at the expense of the currency. And in this case, it'll be more QE, more buying of bonds, more expansion of the balance sheet. Buyer of last resort is still what the Fed is, the Treasury are really all about when it comes to the bond market. And that only bodes well for gold because that talks to the, basically the debasement of the purchasing power of the U.S. currency.
Tell me a little bit about what CTAs are doing, Greg. You're a CTA, and up to this point, they've been out of gold and silver. What are they doing now, and what impact that will be if they come back into the market?
Well, it's funny because I actually want to say, CTAs are back in the saddle because we kind of are. I mean, the hedge funds had a rough run in the second quarter. We had a bit of a drawdown because we had to we were trying to catch the stock market short. I still think the stock market is very vulnerable. The dollar's going to come down is good for stocks. So I've kind of abandoned that thought process. And we had a small drawdown, totally in the norm of our probability curves. Not a big deal. But it's funny because 2 weeks ago, I kind of started to get excited because I think we're coming out of this because the next opportunity is appearing. And it's an opportunity that we've discussed since February, in April specifically on your show, which is El Nino and the impact on food commodities. You're talking about weather that is already off the charts. When this started, the first alert was in February. It was the end of February. It's just an alert, what they call an ENSO alert, ENSO from the NOAA. And then in April, they issued a full-blown El Nino alert and said 25%, it was 1 in 4, quote unquote, 1 in 4 odds, probabilities, excuse me, that this would be the worst El Nino in recorded history, okay? And it would last into the summer. Well, now, as of July, they've revised that estimate twice. It is now 97%. It will be the worst El Nino in recorded history, which dates back to 1950, but geologically, they can also mark it further back. And it's going to last through April, May of next year, meaning it will not only impact this crop season, but next year's South American crop season. You have a lot of these crops with razor thin margins in supply demand dynamics where demand continues to run high. If you don't have record supply, especially in something like soybeans, all right, take cocoa, for example. It's already doubled this year and it's barely broken out because it had gone way up and then come way down. And now you're talking about Ghana and the Ivory Coast, two different places, get two different impacts from El Nino. It's the little boy is what El Nino means. And the little boy is throwing a temper tantrum. And that could be all over the place. He could be crying. He could be throwing himself on the ground. He could be doing all kinds of things. That's the impact on the weather in different places in the world. It affects it differently. So in Vietnam, you have one impact on coffee. Indonesia, one impact on coffee, Robusta coffee. Then you look at Brazil, big impact on coffee there. So you have cocoa, Ivory Coast, and Ghana. You have coffee in these places. You got sugar in Thailand and Brazil. All these food commodities now are coming into play. And finally, about 2 weeks ago, CNBC picked up on the story. And just yesterday, Bloomberg picked up on the story. And now all of a sudden, like it always is, and we talk about this, when it's below the ground, I'm going to see it because I'm digging into the macro visible in the micro, but you need it to be macro visible for the markets to react. And you're starting to see that. And I said back in February that probably the big thing by the second half of this year would be El Nino, crops, weather, and food price inflation. You haven't had that. It's been one of the things that has disinflated and caused a great deal of relief in a lot of those food commodities. That's going to change here. And that's a big deal and a major complication for Warsh.
I'm going to turn our attention to another commodity, and that's oil. So the attention on oil, Trump saying it's going to come down next to nothing. And what I think the market's ignoring, Greg, is the shortage of what's going on with refineries, with diesel fuel, with jet fuel. When you have two of the biggest oil companies in the world, Chevron and Exxon, their CEOs coming out and saying, you're missing the big picture here in terms of what's going on with refineries. The market seems to ignore that. And then I would add probably a bigger story that I think is longer term is almost 3.1 trillion of underinvestment in by the oil industry because basically they weren't investing enough to replace what they were producing. And that is going to catch up with us in the next couple of years. And that's a bigger story here I think the market's ignoring.
I've been writing about this since April, and it really has been eroding very rapidly since April. You've got declines in commercial inventories of crude oil in this country that now expand beyond 60 million barrels in the last 4 months. That is a big, big number. And when you throw in SPR, which has mitigated some of this because the drawdown in SPR is an add to commercial inventories, so you'd be even down more when you include SPR. And total U.S. inventories, Jim, are the lowest since the late 1970s. I mean, this is a major, major issue. Not only that, we talk about being energy independent. That's all well and good because when you include natural gas, we're not petroleum independent. Why? Throughput is 17 million barrels per day plus. What is throughput? That's the amount of crude oil that's pushed through refineries to produce stuff. Jet fuel is not such a problem in the U.S. It's a problem around the world. But in the U.S., you talk about gasoline. I mean, you are way below year-ago levels, major deficits compared to a year ago, even though you're producing more because throughput's so big. And the throughput at 17 million, we're producing record amounts of crude oil, but it's barely 14 million. You have a 3.3 million barrel per day deficit in crude oil. And despite producing more gasoline, we're still seeing stocks draw down to levels that are usually equated to October, November when the driving season is over, and we're barely, halfway through it. So I think the dynamic around gasoline, thinking it's going anywhere south to 265, and when we were peaking and this started, you just knew, okay, you're gonna have a psychological response, but there's value here in energy at certain lower levels. 65 on WTI, you barely got there, and 265 on gasoline, you got there for a brief moment. those were our levels back then. And now I think, you're talking about, higher, okay, just on the fundamentals here, let alone what's going on in the Middle East. And if you think Iran wants a deal other than to ship their own oil and they won't blow it up before the midterm elections, I mean, where have you been? I mean, this is just a situation where they have outplayed us in the sense that they have gotten their objectives. We have not. Our objectives were to denuclearize them, okay, and remove the threat. We haven't done that, okay? What they've done is prolong this, taking it towards the election and causing it to, make Trump look bad and maybe lose votes. And now there's a lot more going on in the political situation in the U.S., thank God, for the Republicans. But, this could have been really bad and still can be, because there's no way Iran wants a deal. That's ludicrous to even think they want a deal in the first place. They want to prolong this for as long as possible. Xi is pulling the puppet strings through Pakistan. And so I think it's a general, cluster, what.
Well, and also, if you take a look at what comes out of this, they want to charge fees to transit the strait. So if you take a look at, we're actually worse off than before the war, because before the war, ships were flowing through the Straits of Hormuz. There were no fees. Iran wants, and even Oman to some extent wants fees. So that would make gasoline more expensive there as well.
100%. And I think too, it's gotten to the point where Trump has been so, polarized in his views from one day to the next. I mean, we're going to destroy the civilization the next day, and they're begging for a deal the day after. And you just can't trade the market. That's why it's been really difficult to handicap this, because it's almost bipolar. And I'm not saying he's bipolar. I'm saying what he says is bipolar. All right. It's polarized. And when you really kind of think about it, I mean, at the end of the day, he's not going to get to control the Strait of Hormuz, and he thinks he will. But all of these all-in bluffs, and they finally figured out he's bluffing. And when all of a sudden the Suez Canal and Egypt were involved, of course he's going to backtrack as fast as possible to we want a deal, we can get a deal, blah, blah, blah. So I think this has been poorly played from the beginning. And I would say even, the other angle that, I have some issues with, and I like Trump's policies, and I certainly am not a fan of everyone else on the other side of the aisle. All right. But having said that, can we criticize the people we support too? Yeah, absolutely. I mean, blind love is just as bad as the other side of the aisle. So in this case, to me, like, alienating Canada, I think this was a mano deal with the Canadian PM and Trump. I mean, but this is a mistake. And when you look at a market like the uranium market, I mean, they produce a lot of uranium. They're our number one provider of uranium, and we're going to need a lot more of it. So just even the special I did on uranium today really shows that we, one of our most trusted and reliable allies. I've never met a hostile Canadian person until just the last year. I mean, it's, ever in my life, and travel to Canada all the time. Gaspé Peninsula is beautiful. We're talking about Vancouver. I've been to many times, Montreal, Toronto. But end of the day, these kinds of mistakes coming back to kind of haunt us. And what does it do? It all erodes the value of the dollar internationally, which is already eroding. And people can say, well, if we can get the Middle East in line and bring them into SWIFT and we can control the whole ball of wax and we'll go back to being a petrocurrency, that's not happening. No way. So this all plays into the whole, if you want to be gold and silver centric. This plays very well into these markets to being at new all-time highs at some point in the next, 18 to 36 months.
Greg, what about the change and coming up to the midterms, which seems the strategy of Iran? If they can keep the price of oil, the straits closed until election, maybe the Democrats take over. But what is even more alarming is the rise of communist and socialism, that they're winning in broad races. The type of money and taxation their policies would create would really be horrible for the market.
The problem here, Jim, is a real issue of the biggest polarization that we've had, as a society, which is wealth. Okay. You can't polarize wealth to the degree where you have 1% and not expect 99% of people to be pissed off. I mean, it's unfortunate. But a lot of these studies show the reason this is popular is because the American dream has disappeared. And this is now becoming more of a common, talking point. But this is something I read some of these psychological studies and how communism and socialism get started and these kinds of things. It's usually in these kinds of situations where people don't feel empowered anymore. And I wonder at what point when you're paying taxes in a state like Minnesota or California or New York or Illinois, and you're seeing that just, the people in power there are just letting that money be stolen by anyone who wants to take it. When did these people rise up and say, I'm not paying taxes anymore? I mean, starting to see these kinds of things. I, for one, am not a proponent of that, but I live in Florida, and that's why I live in Florida. All right, happy to pay the federal government to protect our country and do all the things they got to do and support the military and all the people that really do need support, from a social standpoint. But the degree to which some of these states are just out of control now, and you look at New York, and yes, and you say, how can people think this? How can people vote for these people? It's because they're pissed off, especially the younger generation who've grown up with social media, where they think a couple of headlines they read, that's the whole story. And the attention span shortening, a lot of this is science. People are disconnected from the vibration of the planet because the vibration is rising. The human heart stays static. It's always been 7.83 hertz, the human heart. 7.83 hertz is the resonance of the planet. It's up to 8.29 hertz. People are disconnected physically, electronically. And so you have all these things spew into one big mess that's ultimately going to lead to something more significant. And I just liken back to when I was a kid in grammar school, not beyond the time of this happening, but learning about it in what they used to call social studies, was like the McCarthy era. Or if you're a communist, oh my God, you're going to get, they're going to throw a hood over your head and knock you out and take you off in a van and you'll never be heard from again. What a difference that is in 50 years. You talk about destroying ourselves from within. That's exactly what we've allowed to be happening here. And it's not going to change.
Greg, can you ever...
You have too many people that can't afford to even buy a house. The whole American dream is blown. And all these people are really just ignorant. It's not they're stupid. They just don't know, and they don't learn, they don't read, they don't, it's that the facts don't matter anymore in terms of what this ultimately leads to. And especially when you have 60 trillion in debt, it leads to us being an Argentina-like country, a Venezuela-like country, where China becomes the US and we become the third world country. Unfortunately, it's sad for me to say it. That's the risk here.
Can you ever recall a year like this year where so much has been dependent on geopolitical events, and like you made a reference to the bipolar comments coming from the president? One day it's peace, the next day we're bombing. So it's kind of hard to maybe take even a short-term position because you don't know how the geopolitical dynamics are going to change almost on a daily basis.
No, it's made it exceptionally hard. And I think that's the reason, I know that's why we've had a drawdown. I mean, I would have thought this would have affected the stock market in a more significant way. You can talk AI and chips and computer peripherals and data center build-outs all you want. It's still, when you're looking at industrial production, which is a good gauge of these things, and you take capital spending, I mean, huge amounts of money is spent capital spending. That boosts GDP. But companies have told the Fed, and all their surveys say the same thing. Corporate financial officers tell the Fed repeatedly that a lot of this capital spending is done to replace human labor. All right. So in this case, we know what's coming next, which is going to be a higher unemployment rate. We already know the only reason the unemployment rate's not already higher is because so many people are dropping out. The dropouts to the new jobs is running almost 4-to-1. I mean, that's unacceptable. The participation rate in the U.S. Labor market is the lowest since 1976. It's like a 60-year low. That's unacceptable. So when you talk about all these things happening at a time when we have this war where we don't know what the hell it is from one day to the next is different. Everything is polarized like this. Everything is vibrating more rapidly at each end of the spectrum. And this is just part of it. And you say, yeah, the bipolar nation, because this is what I've called, since some of my landmark speeches on this, the exact scientific type of stuff. This is the age of polarization, of atomic polarization. And you're seeing it. So this kind of thing is very difficult to deal with. That's why we've kind of had our drawdown, because you look at markets, basically they've gone almost nowhere, but then they've been like this the entire time. So I think we're coming out of this. I do. Even, it's almost like the war, it's kind of getting swept aside a little bit by the markets finally, which are now starting. There was a time period where the macro data didn't matter. Where it's like, why am I even writing a GMSR on the macro data? Because no one's paying attention, because it doesn't matter. Because Trump might say something tomorrow that changes the whole picture. And then 36 hours later, he says the exact opposite, changed the whole picture. So it's been very difficult to handicap. A lot of people have gotten chopped up, including ourselves. But, I've seen this before. I mean, this kind of market action is not that abnormal. I mean, I remember a time in the, first half of the 1990s after the British pound imploded and currencies went dead for like 4 years. And everyone's saying currency markets are dead. You're never going to have volatility in currencies again. Until the Asian targets started seeing their export numbers go on a negative year-over-year basis. Next thing you go, you got the Thai baht and the Malaysian ringgit get slammed. It always returns to where it comes from, and we will pass through this period of time when markets are really going nowhere and spending a lot of energy doing it and really making it difficult to handicap. And I think what we're talking about with the inflation picture and the dollar is going to make this, give us a little more clarity and give us a few more trends where we can be, really take advantage of that to help our investors, protect the purchasing power of their wealth and income.
So, summing it up, Greg, it looks like, as we mentioned, gold has broken through its 50-day average. Silver is touching it, and along with copper. So, it's back in the saddle for commodities, it looks like.
Yeah, absolutely. The metals, I mean, gold and silver, yes. Even the mining shares. The mining shares will come next. So a lot of people already asked me, which mining stocks you buy. I'm not. Okay, I like the metals right now. All right, copper. I think copper has been held back by all of this, and copper's fundamentals. All of a sudden, you're seeing big drawdowns in the inventories of copper, Jim, both in Shanghai and in New York. Now, in the U.S., I should say, or London, the U.S. And you're talking about, okay, Shanghai copper inventories are not like dangerously low, they're not in a danger zone yet, but they are in terms of Western warehouse inventories. They're into the danger zone. When you get below 200,000 tons, that's the danger zone. You were at 420, now you're down to 230. So that's a big decline over a pretty short period of time. And everyone's talking about not buying copper because demand could be lower because of the war, because you have the, some slack in some of the economies around the world. But the final demand side in copper isn't necessarily as much global macroeconomic as it used to be, as it is as a strategic metal. And I think that copper has a lot of upside here. I think that uranium is also back in the saddle, same kind of very well defined, technically very tight Fibonacci moving averages, what I call the double kill zone. When you see something on a weekly chart comes down between the 38 and 50% retracements, and the 52-week and 2-week moving averages are right there. I mean, that's a thing of beauty. And I've seen it so much over my career, I actually gave it a nickname. It's called the double kill zone retracement. You've seen a lot of that in these markets, in gold, silver, and in uranium. And I think copper has just hung out, and all of a sudden it's at new highs with declines in inventories. And it's interesting because the cash to 3-month spread is still a little bit backward in contango, bearish contango, but the 3-month forward spread is in a deepening backwardation, meaning a near-term price premium, because there's not enough metal out there to meet demand. And while one of the reasons copper hasn't continued higher, Chinese imports sloughed off at the beginning of the year. They picked up dramatically in July. And the Chinese don't normally do what they've done with copper, which is buy it at a new all-time high in renminbi terms. And there's another reason why I think the renminbi, and I said at the beginning of the year, the renminbi would be the strongest currency on the planet this year, and it already has been. And it's breaking out fresh just right now. It's violating the 40-year dollar uptrend line. All right. So this is big picture stuff. And when you talk about, we want to import all these resources, and the prices are going higher all of a sudden again. Well, a stronger renminbi makes it a little less expensive for the Chinese to buy and import some of these commodities. So the base metals look good here too. You got breakouts in zinc and nickel as well. The DBB is the base metal ETF for your clients, and the COPX is the copper mining equity index ETF. So those are both viable plays right now in terms of the copper market.
All right. Well, listen, Greg, as we close, tell our listeners about the Global Macro Strategy Report, which you're the publisher.
Sure, it's I do it myself. So, and it's usually, you've seen it. It's usually very in depth, very long, and really put it out as often as I can. It's 3, 4, sometimes 5 times a week, but it covers the world. And to me, it's still everything matters. And it is what Bruce Kovner, the great trader from Caxton, once said, it's a 3D chess game. And that's what it is. It's a multi-dimensional thinking man's game, these markets. So the degree to which we offer specific recommendations in foreign exchange, stock indexes globally, all the bond markets globally, the precious and industrial metals, all the energies, the agriculture commodities. I mean, so we're futures based, but we have a lot of equity work in there. We do quant work within the GMSR. So it's I think it's a pretty valuable product for anyone who's trying to do it themselves. We have retired individuals. I have an 88-year-old that lives up the road here in Florida. Never met the guy, but he's subscribed because he loves reading it, because he manages his own money. We also have just down the road in Miami, the world's largest hedge fund is one of my clients too. So it really ranges for all types of investors out there. I am also a Series 3 registered CTA with a pretty, rocking, knock on wood, track record since we created this program in 2018, the Inflation Buster program. It's done very well, and we're open to new investment. It's a high minimum for accredited investors only. So if you want information on any of this, a free trial to the research, my recent piece on metals, you can email me at Greg Weldon, GregWeldon, at Weldon Online. I'm also on X at Weldon Live and on YouTube at Gregory_Weldon. We also have the podcast, Jim. We're in season 4 now. That's can be found on Twitter. It's hosted by Buzzsprout. And on Twitter, the handle is at @money_podcast.
All right. Well, listen, Greg, as always, pleasure having you on the program. Have a great rest of the summer and come back again.
Absolutely. Beautiful afternoon. About to hit the bicycle and take a little ride.
Take care.
To speak with our financial planning and wealth management team, visit us on our website, financialsensewealth.com. If you aren't already a subscriber to our weekday podcast and would like to listen to more of our content throughout the week, go to Financial Sense and hit the subscribe button.